Hello, my name is Dr. George Mochocki, and welcome to Retail Merchandising. Today we'll be covering Chapter 10, Accounting. Retail Merchandising from Accounting. Before you go, oh no, not accounting, I am just going to give you a overview of an accounting. Some principles specifically for some of you, most of you are in a fashion degree program, and you have to understand some business terminology accounting. You'll always, if you're going to go, this is going to be your career, you're going to go work within as a retail merchandiser, a buyer, or a department head, or you're going to open up your own store, you have to understand accounting. Accounting is the language of business. It deals with the money. How much money do I make? Which products do I sell? Is how much return on my investment to advertise here? How much inventory do I control? How do I get a loan? What is a good rate? When should I pay my bills? How should I pay my bills? Do I do an installment plan? Do I do debt financing or capital financing? All these are terminologies you have to understand. You have the creative side, the artistic side in producing your product. You know your product. Now you have to understand the managerial side. You use that same creativity, but put logic to it. How much? How much money do I need? So in this course here, you're taking me online or in a face-to-face class. If online, we discuss this within our forums. In the face-to-face class, we discuss this in our lectures between our class discussion, or collaborative learning. What you're going to find out, you're going to read the material, read the book first. Read the book. The author does an excellent job, gives you into detail. Sometimes a little bit dry, but that's accounting. There's no way around it. You have to understand the rules and procedures. It's hard for a creative person to get into that box, for lack of better words, but you'll do well. Every job, every profession has its good and has its bad. Some people who are accounting love accounting, but they're not creative. Other people are creative, but they don't like the accounting, or they don't like the number side. If you could do both, there's no stopping you. You could be very successful. Okay, so now, what you're gonna do if you're in retail merchandising, what I would suggest, especially at a community college or at a college level or a small business, take a course in QuickBooks. QuickBooks is the software for a lot of small businesses utilize it. I learned the different journals. I learned the accounting. There's a lot of your point of purchase, your registers are all tied into a QuickBooks software. So it takes that information. It gives you the cost of goods. All those numbers are great when it spits it out. But what does it mean? You have to understand the relationship. And that's what I'm going to say. What are these ratios? What are these ratios telling me? What is the turnover rate? 3 turnover. What does that mean when I divide it into 52 weeks? That tells me, so many days my inventory. All that you need to understand is, because I can't be in business if I can't make a living or keep my business sustainable. And sustainable, pay my employees, pay my suppliers, pay my rent, pay my advertisers, you know what I mean, and still have some extra cash to reinvest into the business so it could grow. As it grows, you're going to ask for a loan. They're going to look at what kind of collateral. Do you want capital financing? It means I got some collateral. I'm going to give some goods. I'm going to bring in partners. Or do I want debt finance? I'm going to take out a loan. And what percentage? What makes sense? What's a short-term loan? What's a long-term loan? What's liquidity? How quickly can I get turn money over? Okay? So, whoa, Dr. George, please! You need this, all right? Now I'm going to go through this slowly. It's going to be a little bit dry. I won't, I'll give you some ideas. All right? So, the 3 statements that you're going to be required in any business, whether you're going to own your own business or you're going to be a manager or you're going to be looking at your own budget or budgets. First of all, make sure you learn Excel spreadsheet. Take a class in a computer, spreadsheet. You don't have to be good, but you have to know all the software. QuickBook is a smaller version of Peachtree, which is a larger version that corporations utilize because they have more deductions. It's more complex type of a system versus a smaller business. Only have a few levels or a few journals, a few activities. Where larger ones, I have more. Okay, so but you get a good start there, working your way up. Okay, so you have to know Excel spreadsheet, all the budgets. That's the baseline. Just so you know how to move in the spreadsheet, cut, copy, how to put some formulas in, makes your life easier. Okay, that's the software. Now, the three financial statements we're going to be talking about that you have to understand. The first one is your income statement. Your income statement, your profit or loss. How much money is I'm making after my expenses, how much is left for the business. Okay, similar to what you own, your W-2 form, for lack of better words. The next statement is your balance sheet. Your balance sheet tells you how much assets I own. I own this car, I own this house, but how much does the creditors own, or the bank liabilities? And when I subtract the two, it gives me my net worth. So if I own, I look, I got $1 million of assets. Wow, geez, George is really worth $1 million, but I got $1 million worth of liabilities, loans out of that. My net worth is zero, because the creditors own that. If I don't pay on that, I mean, technically it's mine. You can say $1 million, but in reality, what's my equity in the business? And that's no different than when businesses are looking at it and they're trying to get you going for a loan, or you're trying to get an investor. They're looking at, I give you $5,000, $10,000, how much assets you have in case the business goes under the loan that I could collect. I could sell off this to get my $5,000. If you have zero equity because you got all these loans, you're going to pay for a loan at a higher rate, or there's more restrictions on what they want to give for you to get that money, that income that you need. Okay, that's my balance sheet. The next one is going to be my cash flow. If I look at my cash flow, the cash flow is how much money I have. That's my checking account. Can I pay my bills on time? What if something happens? Do I have a reserve cash? Those three statements, you could tell the health of an organization or a business. And those three statements is what most of your investors, suppliers are going to look at. Those three statements, you should be at least very comfortable, because they're going to tell you how your business is going, how much money you got left before you better get a good client to buy some of your products, or you're going to be out of business because it can't sustain itself. All right, so let's go on the website. Okay, so here we go. Remember, the websites. This one I threw it. Let's show this one. Let me show you why I put this one in. Here's a website that says French New Approach. When we talked about logistics last week, the chain. I'm the producer. I go to manufacturer. I go to wholesaler, and the distributor. And finally goes to me, the retailer. What if I could control that whole aspect? I produce it. I manufacture it. I deliver it right to the customer, all in one-stop location, something like a tailor. Now, this is what the French approach for a kind of a seamstress or a fashion. This lady has the design. She knows how to cut the clothes. She knows how to buy the material, but she wants to produce it herself. And this operation may work in certain segments. I have a boutique. I'm open up in Barrington or Lake Forest, or certain areas in Chicago, the Newtown, where you have a higher percentage of Bucktown, higher percent of affluent, upcoming, young, single, or married individuals without kids, or even with kids that have a lot of disposable income out there that you want to pay. Buy my product. That's what you're doing. Okay, so you're going to open up your boutique. So now just look at this. Is 5 minutes, and we're going to talk about it. Now remember, they have to understand the accounting. They have to understand all that, because they're pricing stuff and they're doing all the work. So they control the whole accounting system, the cash flow, right? The merchandising, the manufacturer, the distributor, the warehouse, or everything. Okay, so let me see.
Julie Bernier is one practical lady. She'd had enough of being unable to find high street clothes that fitted properly. So 2 years ago,
remember,
she set up her
she
own
found a
workshop
need in the market.
Tailoring.
This is in France. Could it work here in the U.S. in a boutique? She's already a seamstress. Most of you are in fashion. You know how to do the clothes.
Clothing has been somewhat neglected. Bespoke tailoring for men has not. And this concept of customized day and evening wear is totally bespoke services. She also has these collections, so clients can go to the showroom, see the prototypes, and then make the alterations they desire. We don't always have a clear picture of the jacket we're looking for or the dress we want to wear, so clients can come along and try items from the collection, check out the different shapes.
Look, her inventory, her stock is very small. She just wants people to get an idea. You have to be creative.
Waistline, and then the way in which it's worn and where it's worn. And by customizing,
and she wears her clothes, her line, small shop.
Personality of person
so she
wearing
keeps
it.
her expenses down.
Which is exactly why Pascaline was drawn to Julie's showroom.
She finds the material. She just has to have
I'm
different
looking for a
material,
winter coat.
different
Okay.
sizes.
I do
She
have
knows
a
her
coat already,
customers.
but I find it a little too traditional. I'd like something more original. Okay, and I want something I won't see anybody else wearing, something unique. So she chooses the model, the materials, the colours, the lengths, high-end made to measure and yet at affordable prices. Blouses
Affordable.
start at €260, dresses and coats from €600. We
That's
have
about
to
like
go
$400. It
workshop
depends
in
on the
Paris,
exchange rate. You'll learn
customised
that.
shoes, and again at reasonable prices. You can get your hands on a pair from €120.
At $80, lady, that's a good price.
Bespoke shoes are made according to the shape and size of each individual wearer. And this
This
how
is
they
his whole
differ from
inventory.
made to measure. I have different shapes
All
and
this.
styles. My different models. The client tries on the shoe, and then we can make them wider or modify the vamp, for example, on court shoes.
He's doing it right there for her, as
The
needed, to
dimensions,
fit your
the
foot.
materials, the colours, the heels, everything is adjustable.
He just shows them different styles. What do you like comfortable with?
This model, for example, has a 7.5 centimetre heel and a slight wedge. But we could have a lower heel.
Remember, you're getting ideas what somebody else is doing. Could I take some of this and some of that and put it to my business? Retail merchandising, creativity, you've got that. Now let's
I make a lot of my own
take the
clothes,
next
and
step.
this means the shoes are coherent with the look I'm endeavouring to create.
Different customs. You got to know your customers, your clientele. Now this is his shop,
Another
the
advantage of
manufacturing,
made to measure
downstairs,
manufacturing
his
is
warehouse.
We're talking from 2 to 4 weeks as opposed to 5 to 6 months for bespoke items.
2 weeks
Korean
versus
had
6
to
months if I
develop
order
Mochocki,
out
used
special
to be a
order
banker,
to
and made
a
the
large
career
company.
switch 5 years ago.
He was a financier, he was a banker.
It's quite a new concept. Well, it's making a comeback, let's say. We used to see it a lot. At important occasions, ceremonies, weddings, people's shoes would match their dress or outfit. This was lost for a while, but craftsmanship is becoming important again. People are looking for products made in France.
And other sectors are now launching tailor-made products. The world of cosmetics, for one. In this Parisian
Remember,
concept
it
store,
just gives you an
clients
idea.
consult a skin
Just-
specialist for a personalised diagnosis. They take samples of dead skin cells, photos of the epidermis, and all the information is fed into the computer.
Utilizing technology. The other one was just handmade. This one's technology bringing you to that, makes your product different, your store.
And from the data we've collected and everything you've told me, I'll put together a comprehensive skincare program. If you're not happy with shiny skin, then I'll give you some zinc gluconate to apply to the T-zone every morning before you apply your moisturizer. Zinc gluconate is one of 40 or so active ingredients promoted by the company. They come in highly concentrated doses, targeting specific areas for maximum efficiency.
Remember, the price is expensive, so if I could reduce something, like my outside, my vendors, my supplier, I could control that.
Routine using a perfectly suited active ingredient when you need it on an ad hoc basis. Some are only used for a few days.
You could just walk in the store. Look at the layout. We're going to talk about a couple of chapters layout. Look how, look, every space. Open. Doesn't give it clutter because it's all high quality. But a variety.
Complement the skin treatment. Customized skin products to suit every budget.
You notice the watch and everything else that she was wearing, not low end. Okay? And then you have other ones, work together, just international. So, and the other one is I don't know what I have on this one. Let me look real quickly. Just a commercial I think I threw in there. 2 minutes. That's part of my advertising. Remember, how am I going to sell? What am I selling? Coke Zero? Interactive. And they're tying in with, it's a game. Did you get to win something? And going to try and slow down these people purposely. Different cultures, right? I'm a business. What's the brand? That poor guy could barely make it. I think this is a great commercial. This is me. Okay, now why did I throw that in? How much would this ad cost me if I had to do it? You could buy it if you do a cooperative by having Coca-Cola in your business, if you're a retail store like some kind of a food store or something else. It's nice. Or you're looking at their outfit. Look, I've got the James Bond look, whatever. Remember, I'm a retail merchandiser. What's selling? Could I add on to this? Could I take this event and make something with it? All right, I'm finished with the videos, all right? I always try to do the videos for you. Okay, let's get into the accounting. Now, Dr. George, what do we have? Let's look at our accounting. Why is accounting important to buyers and managers? And I got this, I think, at 200, so you could all see it. Utilize the concept map. Remember, read it, use my mind maps, add on to it, and see what you miss. That's how you improve on your writing ability. That's how you improve on taking notes. When I'm listening to the class, I take notes with a manual mind map, and then I just convert it into this software. It's called MindJet Professional. All right? So buyers want to know just how their efforts, how effective are their efforts? I must have missed something else. Contribute to the goals of the organization. Come on. If I'm a good buyer, I'm bringing in the good stuff, and look, your sales are going up. That means I'm buying the right merchandise at the right cost, or I'm buying a lot of good merchandise, but we're not making any money because my expense, I'm buying it at too high of a cost. I'm at the end instead of at the beginning. I'm not the trendsetter. I'm the follower. So it's going to cost me more. Or the prices already dropped down. Remember the product life cycle that we talked about, the fashion life cycle. It starts off, how it's going to go, how long it's going to go. At each time, there's a different pricing. I have to be cognizant of that. I can't have the high prices in the maturity or in the decline. I got to reduce the price and get rid of the inventory. All numbers, all management, all accounting. I love it. You love it. Come on, I'm trying to bring that energy. Even though some of the accounting, when you take accounting, you go, man, oh, this is boring, just numbers. I gotta stay within the alliance. That's the creative person that drives them nuts. But once you understand that, you hire somebody to do that, but how do I play with the number? That's finance, your creativity again, okay? By utilizing and interpreting what? Financial statements, and we talk which ones. Income statement, cash flow, and what do you call it, balance sheet. Because the same thing they're looking at you when you're going for a loan for a car or for a business as sole proprietor. What do you have? What do you own? How much you own? Man, you go on to business, right? Remember, try to keep your business and your personal assets separate. So if you go, your business for some reason doesn't make it, it's like a marriage. Just say businesses, I think it's like 50% will fail within the first 5 years. Marriage is a little bit higher. The numbers are going down because people don't marry as quickly as they do. They prolong the marriage to last end, so you don't have as many people in that pool, so the numbers look better. Or if they come in, they're coming in later where they already got the contract or something else. They already know what they're looking for. They're not jumping into that one night and then all of a sudden I want to marry you because I love you. But 2 weeks later, what did I do? All right? Remember, your love comes to there after a while, after that romance goes. Same thing with your fashion. The fashion is there. They're coming in there. I love this store. But if you don't change or you don't put some variety in it, they're going to find another store. They're going to find another love. And I show that as an analogy. It's not saying. Remember, you always got to put that variety in there. And that's your business. How do I put that variety? How do I keep the customer coming back? How do I keep that passion that they love my business? How do I change something? Bring another product. Or do I? And some people they get married and they say, okay, the bells are gone. I just want a good, stable relationship. And that's what happens. Once I bring them in there and all the whistles are gone, why do they come back? Because I'm consistent. I come up with new ideas. They're trustworthy. And now you build the relationship. pretty good. I try to use the analogy back from one to the other. Okay, so let's get analyze. Determine that the contribution is profitable. The other one's inputs used by retailers. Okay, I'm looking, and we're going to talk about inventory dollars. How much do I have in inventory that I'm not selling? I got to move this. I'm not making any money. How much am I paying for square foot for my space? I got to have a big lounge. No one uses the lounge. What can I use the space for? I've got all this warehouse basement, and I can't utilize it. But do I keep my merchandise there? If not, open up and make a store, a lower level, say clearance area downstairs, or our new items. Utilize the space. If you're not utilizing, it's costing me money to rent it, to heat it, to do something with it. How can I convert it to making some cash for it? That's a return on investment. Business. You're always talking business. Creativity, return on my investment. Creativity, return on my investment. Okay, overhead staff. Do I need all these people to greet an individual, or I could minimize it? Advertising, and we'll talk advertising. I teach advertising class. I advertise. I have to have a measurement. I spend so much money in advertising. How many people are coming from that ad? And if I can't measure it, I don't know if I'm making it, if it's profitable. If I'm spending $5,000, I may at least expect maybe 100 people to come in. They don't have to buy, but that's a good prospect. And if I got 100, somebody buy, then I equate that to how much they, out of the 150 buy, and they buy $100 each. It offsets what I spent in there, and I'm making some money. So I would utilize that tool. Maybe not the first time, because they're just learning it. I'm learning it. Once I learn, okay, not at this time. Make sure I'm in the middle of the ad. I'm next, not next. Make sure when I post the ads, I don't want to be next to my competitors, because I can't compete with them. They're charging it for $12, and I have $20. Same product. What the heck? This guy's out of touch, or this business out of touch. That's all you learn. Remember, you're learning. Use your tools, but the measurement. Energy costs. What do I use? I swear for ComEd. Electric is good. I save it up front. Builders put it in electric, because you don't have to put all the pipes and all the gas, but the cost is higher. All right, so the front end cost is lower for me, but then the maintenance cost is higher, unless gas is cheaper. And then other what do you call it, management expenses or IT expenses is they can come up with. Okay, now output performance, sales. If my sales isn't moving, I got poor advertising, or my salespeople. My direct sales aren't effective, or my goods are outdated. No one's buying them. Maybe I got to find a different market. Maybe I got to change something. Cash flow. I can't pay my bills on time, so my credit rating goes down because I'm always late. My credit rate, even though I pay them, my credit rating goes down. I have to pay a higher interest rate because now I'm a risk because I'm not paying them on time. That means, when I give you a loan, I expect the money so I can pay off my bill. But if you're late, it delays me. I got to do something to offset the deficiency because you didn't pay me on time. So now, sure, I'll give you another loan, but at a higher interest rate. The higher interest rate means it cuts into my profitability. I got to pay more to buy my products. So since I'm paying an interest, I can't get as much of a product because I got to pay the banker or the other person in the distribution channel, my usury fee, for lack of better words. Growth and sales profits. Are we growing? Are my profits going? A lot of businesses, sometimes you'll look at them and evaluate them. They have a good steady income, a profit. I mean, not profit, sales coming in, but they're losing money because they don't understand the expense side. Look how much I'm selling. How much is it costing me to make something? Costing me more to make it than I'm selling it for. I should raise my prices. If not, find my market and put in some value added. Remember, that's advertising into my store. When I go to Nemus Market, I could buy the same jeans at Walmart, Kmart. Maybe, if the numbers are the same, a lot of times they are. Why am I paying? Because I don't have to wait. They wait on me hand and foot. I get my little coffee. I get my everything. I'm paying for the decor. I understand that, but a different customer base versus what the customers that are coming to Walmart. If I look at the amount, they're maybe making the same amount, selling more for lower prices, selling less for higher prices, but making the profit margin the same. That's how I'm looking at performance, okay? Not too bad. Come on, I'm getting you interested in that. Okay, cash flow. People who have a lot of money, but they don't have any cash because their money is tied up in investments. And we're going to talk about positive cash flow, negative. We're going to talk about liquidity, how quickly I could turn cash, real quickly. Anything, what's the most liquid asset you could ever find? Cash. Or a debit card, as long as your debit card is not overdrawn and the bank is working. Or if you're not in Greece. Greece, you can have a debit card, but you can't take the money out because the bank's not transmitting. They have a banking issue. So everything is cash. Cash is the most liquid. The next liquid is accounts receivable, because people owe me money. I could convert that, sell that to somebody else in IU, and they'll be paying them on a regular basis. Okay, so let's go look at cash flow. So I've got the cash, I've got the businesses, but I don't have enough cash to pay my bills, my creditors, my ratings go down, my credit score goes down. So now I have a low credit score, so I had to pay more for when I need a short-term loan to bring my inventory. Not effective. So what I want to do is have a good cash flow to pay my bills, pay my employees, pay whatever comes in, and have like a little cushion, so if something happens, I could pay it off without taking a loan to pay to get that item repaired. Okay, so cash flow, balance of cash coming in and going out. That's all it is. How much money I get paid, how much money, how much bills. What do I got left? I got a rate. I got nothing. The wife takes this. Hey, honey, I love you. A lot of the kids take this. What do I got? $5. Go to McDonald's. And even McDonald's, I can't buy anything for $5. I could. I'm just kidding. Okay, positive cash flow means that you have more cash coming in to the organization and going out. That's what you want. Can negotiate terms that delay payments. Remember, in business, when you're looking at accounting, my whole thing is get the customers to pay me as soon as I can. Give them discounts and everything else, but pay my bills at the last minute. Because my bills, my money is making money on me. It's not sitting underneath my chair or in a drawer. I have it making money. So as long as I'm making money, even if it's in a savings account or now account, you're making very little, but I'm making a penny on the dollar more than it would be sitting making no pennies on a dollar. And if you got a lot of dollars, you're making a lot of pennies, which would be more dollars. Okay? A supplier to increase cash flow. Okay, can negotiate terms to delay payments to have more cash flow. Look, a lot of you, when you're paying bills, everyone's paying the bills, they all come up to 15th, and you get paid twice a week or twice a month, whatever. You could go to your credit card company or your utility company and say, hey, look, I got all my bills on the 15th. Could I have your bill on the 30th? They don't care. They'll pay you that one time. They'll do the adjustment, and now you could balance your payments. So this month, every 2 weeks I get paid. I pay ComEd. This month I pay Comcast, North Shore Gas, whatever it is, or Nicor, whatever they are. All right, and I'm all done. Do you see what I mean? And you could do the same thing. Make negotiation. When could I do it? Instead of 30 days, the one day they want their money because they're making what do you call it? It's going to affect their cash flow, but after that, you pay that penalty, you can manage it. You can't pay every month. They have a free, you can pay every 2 weeks, pay every week, but you're paying that service charge. So you're looking at how much is it? It's I'm late, but it's easier for me to manage that way. Positive cash flow is what you're looking for. Now, if I have a negative cash flow, that means I got cash going out, more cash going out than coming in, short-term borrowing. I got to take a loan to make it. You got paying loans. You don't want to do that because you get more into the hole because the interest rate, you can't pay them back. So once you get it in there, you're just maintaining what you owe them by paying the interest rate. So as we call annuities or compound interest. You learn that in accounting and in business, or if you've taken any kind of at the college, you have to take a math class or a math competency class. So or in business, here's what you do. In business, if you're all freaked out of numbers, in business, what you really need, you have to understand the stats, but you don't have to really create them unless you're going up for your master's and your doctorate. In business, I have to understand percentages. I have to understand decimals. Remember, I got a decimal 0.09, and percentage is not just like 9%. It's only a percentage of a percent. Right? So a lot of students don't understand that. You have to understand your spreadsheets, and you have to understand very little algebra. Your X and Y for that. Once you do that, you shouldn't have any problem in any kind of math. I know some people take stats a little bit harder. You're at the higher level, or you'll take calculus, depending. If you're going to statistician or the numbers, most everyday people, if you know the percentages and a little bit algebra, you'll do very well in accounting and in math. Those are what you need. So here's my cash flow. In October, cash in, right? Look, the numbers down. More cash out. So which months I know I got more cash coming in, positive cash flow, I don't use that. I retain the earning and I save it. So in here I know, hey, business is down. I reduce my expense. I don't work overtime. I don't do anything else. Or here's where I make most of my money. I save that money to level out so my cash flow is even. So I have money in there, an account. That's what you call in some kind of saving or retain earnings. What we're going to talk in business. Okay. Man, it's not too bad, class. You take accounting, or once in a while I teach finance or international finance, and it's more with the numbers. But remember, I'm teaching you strategy, but you still have the numbers, the software. You understand the software? The whole thing is just the calculator. I can put the numbers in. Is when that number comes out, what does it mean? That's what I'm trying to teach you. You have to understand what's the relationship with that number. What does that tell me? Okay, now let's look at your balance sheet. Your balance sheet, your accounting equation, your basic equation of your balance sheet. Look, when you turn in a balance sheet, when you take accounting, I can look at the numbers and say, you do all that work. Your journals, your assets, your liabilities. You figure that all out. What happens is I look at it and say it's wrong. How do you tell? Balance sheet, balance. This has to equal this. That same number. This is my assets. How much the company owns. Okay. This is how much a company owes, and then I take this and subtract these two, and this is my owner's equity. So my liability is my owner's equity, right? Well, how much the company's worth, remember? That's his balance. So these numbers, this final number and this final number are both equal. Okay, it's a photograph of what's going on at the moment. It tells me how much I owe and how much I own. And how much, and what's the company's worth. Any transactions, when I got inventory, it raises it up. I got a bill that I paid up, it raises it down. So you got your credits and your debits. A little different. Credit means is a negative in business. A debit, because we're looking at credit cards, and I'm going to give you a credit, but it shows as a negative. People, when you take accounting, you'll figure it out. When you read this, figure it out. Look at the language. What does it mean? Okay? A transaction shipment can change the balance sheet. Okay, assets. How much a company owes. Short-term assets is current assets converted within 1 year. Inventory, I can still sell it within 1 year. I can make money. I got a garage sale. I could get the cash right away. Those are current or short-term assets. What I could turn over and sell within 1 year. Long-term assets, non-current assets, normally converted. Fixtures. For lack of a better word, I own the store. I got to sell it. That's long-term. It takes me longer to sell. Depends on the market. Longer than a year. Okay, so that's my asset. Short terms, under a year. Long terms, over a year. Same thing with liquidity. How much cash? Most liquid, convert within 1 year, or the most liquid one would be cash, and then my debit card, then accounts receivable, because I could sell them as a factoring. I factor in, I said, here, you owe me $20,000 at 5%. Hey, George, I need the money. I'll sell you George's account for $18,000. I factor that in, and so he still owes you the $20,000. All right, I took $2,000 off. I needed the money, so I'm making money. I get a short-term loan, and then I got a long-term person always paying me back, owning me. Okay. Liability: how much does the company owe? Short-term: how much do I pay within a year? My credit cards and everything else. And you're going to talk about with collateral debt and uncollateral, debt. If I got collateral with it, it's going to take me a little longer, but I get a better rate because if something happens, they can sell off my asset. Uncollateral, your credit cards, they have to go after you, sue you, and try to get the information out. Collateral, you put something up against it. If I don't pay, they could take that or have rights to that portion of the asset that I owe. Okay, again, long term, over a year. Get it? And then owner's equity. My map is acting up today. That's okay. Okay, owner's equity. I think if I open up the other one, give it a chance. We'll work it out. Okay, I got it working. Just a little glitch in the system. I got a lot of programs open. What does a balance sheet look like? It looks like this. So when you take an accounting, real rigid looking, right? You got to put it this way. It gives me my current assets, accounts payable, salary, all this information. I have to know what the numbers are. How I'm going to cut my expenses. Where could I cut it? Prepaid expenses, taxes. Could I hold off on that? Paid equipment. Is there any kind of depreciation? How much is the land worth? Remember, this is what you're going to be doing. Not in this course. Right now, I just want you to see what one looks like. And then when I look at the comparative, now I have different assets. This is my balance sheet from last year and this year. And what am I looking at? Okay, accounts payable. How many people that I got to pay, or accounts receivable, or these are my liability. Percent went up 16%. What in 2010 from my accounts payable for here, there's a 16% difference. What changed? What happened? Percentage from my liabilities to my owner's equity. What happened? So I'm looking at the numbers. I must have did I buy more? My accounts payable? Did I take out more loans? Stockholders' equity. I think I got another one in here. Here we go. And then I go, stockholders' equity. Did my stocks go up? Common stocks, right? 23%. I dropped a little bit. My stocks went down. Retained earnings. How much did I keep? I'm keeping more money. Retained earnings. Stock. Remember, this is how you analyze. I look at last year's and look at the variances. What's changes? What's the percentages? That gives me an idea. Am I on course, or I'm doing worse than I did last year? Okay. Hopefully you're doing better than you did last year. All right. So we got rid of this. We got the balance sheet. The next one we're going to shoot over here. Oh, you only got a few more. Okay, now let's look at financial ratios. Let me just cut these all off so I could talk on them. When I look at financial ratios, there are two numbers that give me a percentage or give me a ratio, like we did with the inventory turnover. You get a number 3. What does 3 mean? Divided into 52 weeks, and it tells me how long I keep my inventory before I get rid of it to make money off of it. If I shorten that inventory to a smaller amount and still and sell more, I have more cash flow because I don't have to keep the inventory. It's not sitting for 26 weeks. I could get rid of it in 15 weeks. Smaller time. I get more cash coming in there, improves my cash flow. Okay, now the ratios, what you have to understand with the ratios that I've explained before is a benchmark. The ratio doesn't mean anything else unless I'm comparing apples to apples. So if I'm looking at the ratio of turnovers, and I'm looking at a grocery store, perishable goods, their ratios of inventory turnover should be maybe a real high number, like about 27 or something. So I'm turning over my produce at least within 7 days. I got to move it, otherwise it's going to be spoiled, rotten. I got to get rid of it. Different, right? So I have a real high turnover number. Let's say it's something like 27. I'm just making up the number, okay? 27. I'm selling Mercedes-Benz cars, or I'm selling Lexus or BMW, high-end cars. I may sell in my dealership maybe 2 cars a month. And I look at other high-end dealerships, and they're selling 2 or 3 cars. So, I keep the cars for 2 or 3, again, for a longer period of time, maybe for, 6 months before I could actually sell it because it's a high-end car. Do you see how the ratio for the perishable goods is high, and the ratio for my auto industry is a lower number, longer? I keep my inventory for a longer period of time. Different industries. So I have to measure my produce with another produce store. If they, I'm keep my inventory for 7 days, and they're keeping theirs only for 3 days, they have a better selling, better pricing. They're moving their inventory faster. They have less spoilage. If people all of a sudden don't have a taste for something, or they say, hey, we got some kind of salmonella out of this one type of a fruit, or peanut butter, or peanuts, whatever, all of a sudden, boom, or cherries, or chicken, they're not hurt because their inventory, they can move it. They get stuck with that, but not as someone who's got an inventory for 6 months. I'm really stuck now. I definitely can't get rid of it. Okay? So now we understand the ratios. So now when I look at ratios, in a nutshell, let me give you the definition, is a relationship of one number to another to make comparison versus previous performance of other companies. When I'm looking at other companies, I'm looking at the benchmark, the best in the industry. That's what you benchmark against. The number side. It's kind of interesting. Look, you could make fun and you could work with this. A lot of people, once they get to the numbers, understand that to be creative, how do I make my bill? We're creative anyway. Creativity is other than just being creative artistically. It's how do I think out of the box? How do I pay my bills? How do I get this done? On my vendor, they come out, well, how do I substitute? That's all creativity. How do I change this? Oh man, this came with a flower, but I don't have it. I make it a basic model. What did I do? People don't know. I just change it and call a different model, and I sell it. I put the 2 colors, and it come out to orange. It came out to some yucky color. I give it an exotic color name to it. Turn around. Hopefully, it's not a fad. It becomes a trend. It becomes fashionable, and then on the business by accident. Okay, current ratio. When I look at current ratios, relationship between current assets or current liabilities. Okay, current within 1 year. Organization's short-term debt paying ability. How quickly can I pay my bills within now? I'm not saying what's in the future. Okay, or ability to pay off current debts with current assets. That's what I measure. Current ratios of 0.75 indicates when you divide the two together that you have assets are not sufficient to pay bills. Right? My asset, if anything happens, I can't pay my bills. My asset, if we go under, credit rating and factors, use current ratios to evaluate business. Okay, so all you have to know it. Formula: current ratios equals current assets divided by current liabilities. Remember, I have my assets. Here's how much I owe, and I'll say if I go belly up, got to sell it. I owe more than my assets were, and that's what happened with the housing crunch. People paid more for what that property was worth because they figured they'd sell in 5 years. The market went down. The house was overpaid. So now I have a mortgage of $50,000. Let's say $150,000, and the house was only worth $50,000. 100,000. That's why people walk away. There's no way I'm going to pay for that. Maybe it'll come back in 20 years or so. I'm losing. It's better off just take the hit, take the bankruptcy, and go for it. Or Chapter 11, and they control it, and sell off some of the creditors earn after me. And we talked about that in previous chapters. Okay? If not, we will. All right? And here's the formula. Average industry is 2 to 1. In accounts receivable, average day collection, net sales. Here's my sales. I got accounts receivable divided by 360 days. There's more. This is when we go in accounting to explain why the number is different, the banker's numbers and the traditional numbers. Industry average is 90 to 120 days that I should get my money back when I do an accounts receivable. 120 days, you got the money out for a long time before and that could be also because I know that 50%, 70% of people will pay within the 30 days, and this is another will pay 90 days because it'll be late. In the 120, they're already ready to go default on me, but they're still paying for whatever reason. Okay. So we got the current ratios. Now asset management ratios, how well the company manages its assets. So I'm just looking at my assets, my long-term, my buildings. Are they being utilized? I look at asset management. If I'm looking at the hotel industry, retail merchandising, they look at how many rooms are filled. That's how they measure it. I have rooms that aren't filled. Even if I fill, that's why you get different prices. You got all these travel things that give you the best prices or compare prices. I could sell it here as this high-end site, sell it and still lower than what they would pay by 20%. Here's the thrifty guy. That means I can't sell these units at all. They're in the corner. Extra ones, I already got these all locked up. Why can't I sell this room? Okay, an empty room, I had to heat it, turn off the air conditioning, the lighting. If I could rent it out, break even, or make a few bucks more, not my profit my profit goals that I'm looking at, return on my profits, but I'm still at least keeping the business going, filling up the lights, and it's paying for some of the maintenance total burden or expenses that I have to pay off. Okay? Assets. How good. So if I got a lot of buildings that are empty or spaces I'm not utilizing, rented out, you see a lot of businesses for their revenues. They got the store at the first, but they own all the property above it, and it could be apartments. They rent it out, and they rent it out. Hey, it's not the best, but I give you a lower rate. You look at the store. You keep an eye on the store. You're still in the building. Come on, extra revenue. Otherwise, that space, I don't pay nothing for it. Make something out of it. Clean it up. Collect on it. Profitability ratios is how much profit I'm making towards my sale to my expenses. And then debt ratios, company's debt situation. How much do I owe compared to other businesses? Utilities have a higher debt because they have a higher interest structure. They have to pay all these transmission lines, all this equipment. You're not going to recoup it right off the bat. It's spread out over a longer time that they look at it, that they analyze it to bring it back into the system. But because that's just the way they have to do it. So they have a higher ratio of debt, but do I compare that higher ratio of debt to another utility? If one is real high, like 90%, everyone else is 50%, something's wrong with this one here. Okay? Now, the next one we're going to talk about income statement. And a lot of times income statement we'll talk about, they call it either profit or loss statement. Right? Your income. Okay, so income statement. Sometimes called the statement of earnings, or a profit or loss, PL statement we talked about. What's the profit? After I pay all my expenses, everything. And look, when you open up a retail merchandise, what you're going to find out in the county, most owners open up, they do not pay themselves. They just look at this, my profit. That's falsifying. That's not falsifying. That doesn't give you a good picture. Because if you weren't there, you'd have to have a manager. How much would that manager charge you to manage that store? Because if you're not taking any kind of salary, that profit, you're being taxed on that profit. Put your wages in there now. Get a tax. I'm working here. Okay, so I'm the owner. I'm making 30,000 because bare minimum. Because if the business grows, I open up another shop or I have more hours, I'll bring in a manager. I have to have him or her managing, so that's gonna be part of my expenses. So now I pay myself a bare minimum 30,000, and then what's left over is the profit. And that's the profit that I look at that I'm taxed on from the business. You see what I mean? Otherwise, that 30,000 will be part of my profit. And what the heck? And it's really an expense because your time means something. Pay yourself. You still get the profit. Because if you're selling the business, if I don't see the owner's time in there, that profit, I could already say, wait a minute, who worked all that? I did that, all that. That's a part of my profit. I don't charge myself because my business is also doing it. How much would it be? 40,000 right off the bat. So basically, you're not profitable. You're losing money. You're making it look like you are. You want to get paid of good wages and still make a profitability that you could give back to the company. And that's what you're taxed on. That's my income statement. Okay, so it's my profit and my loss. Man, I'm really having some problem with this one. Okay, my loss, when expenses are greater than the revenue, net income, negative, you don't want a loss. In business, you look at the balance sheet and everything else, it will either be in bold or in red. Or now they would have in parentheses, that means it's a negative. Right, because you can't, the old days used to be I'm in a red or I'm in a black, and a black means there's no red mark. That means I'm not negative. And now that you got Xerox and copy machines, black and white, they basically either bold that letter that's a negative, or they'll put parentheses, which gives you the indication that's a negative number you're losing. Okay, revenue minus expenses is net income statement. Okay, net revenues. Okay, here's how you do the net income. You have the revenues or sales. You got to take your sales. Here's what I made, but all those returns are subtracted as selling, and then other things that's subtracting from my sales, my costs, and the cost of goods sold. How much? The shipping returns. How much did I pay for the inventory? All that. Not just I paid the $20, but it cost me $20 to ship it. So I basically paid $40 for that one item, or if there's 50 items in the shipping, I add it up and divide between them. All numbers. I got to be actual. I'm not making up numbers. I'm utilizing numbers. Okay, so that gives me my gross margin, right? I take this, subtract this from this, gives me my gross margin, net revenue, minus my cost, my other operating costs, minus my expenses, direct and indirect operating costs. I subtract this, okay, from here, and it gives me my profit or loss. Simple as cake. Look, the author goes through it. You take an accounting class. You're taking me for business organizations. We talked about it. You take for finance. You'll know this. You have to at least be familiar with it. Take QuickBooks if you're doing something else in the business. Learn QuickBooks. You know how to add the data. It does it all for you, but it doesn't do anything else when it spits out the ratios and numbers, and you don't know what that means. Nice number. Like sometimes we got 30%, the blood pressure, it's 80 over 120, whatever it is. If you don't know what those two numbers mean, it means useless to it. Well, I always ask, what does that number mean? Well, here's the average, okay? You have to have the base amount. Okay, a component percentages is a ratio of income statement components, such as gross margin, expenses, or income or net income, to net sales expressed as a percentage. Everything is to my sales. So if I'm looking at my sales, what cost of goods to my sales? Well, gross margin. Gross margin divided by net sales by 100 gives me gross margin percentage. What's my towards my everything's to my sale. It's like my income. If I can't sell anything, all my numbers are just telling me, hey, I'm having a problem. You need new inventory. You need a new advertising plan. You need new salespeople. You need to find another market. You have to do something. People aren't buying your market. What's dropping? Dropping. Okay? And I utilize the thing with LA tans or people who have tanning salons. The law because it changed because you had the one lady that a tanning mom that was tanning her 5-year-old or 10-year-old son. I'm not getting into that, but the people were going, hey, wait a minute, this kid doesn't really know. The parent is already all burnt out, freaked out, wrinkled skin and everything else. They're going to do the same to the child. So they have a law now. Now they says even with parent consent, you cannot tan unless you're over 18. That hurt a whole big market for the tanning area because they would tan for teenagers, high school proms and everything else, going on vacation, get that tan. They lost that whole market. So that's when they open up a new market where they could spray tan you. What color you want to be? Shh. Okay, we can spray you different. 2-tone, 3-tone, 4 tones. A little lighter, a little dark. But still, whether that's safer or not than putting chemicals on you than having ultraviolet, that's not up to me. But all I'm saying, you see how something would happen, and by that percentage, I lost that whole market to sales. My sales went down and had an effect, because that sales for that one product line, the tanning, just, to that one demographic, to the teenagers for a certain age group, I lost that. How do I recoup that? I can't get the, you know what I mean? I have to find another market, or I got to find another product or something that complements me to offset this. Because now all my percentage expenses went up because this one's not bringing the sales. So this is more. So all my numbers are thrown off. You see me by one thing, but just that I had this number that says this, your gross margin's off. Where is it off? What did I do? You have to look at it and find specifically where, and then you're going to come as finance, come up with the creative idea. How do I substitute, or how do I change, or what? How can I work within the laws, or do I bring in a new product or something to satisfy that market need that is no longer available to them because of regulations out of my control, the environmental forces. Remember? Yeah, most companies operate environmental, and they have to be organic. Like that flour, I adjust. Okay, some components, and I wonder what this was. This one's pretty busy here. A lot of information. We're almost done. Let me just go real quickly, and I'm just going to talk about these. I'm not going to go real in depth because this is just a lot of information. You can read it. Net sales equals gross sales minus customers' returns. Remember, they sold it, gave it back, so I can't count it again. Other revenues, rental from leasing property, or interest on accounts receivable. Okay, net sales. I added it. Gross sales after I what do you call it? Get rid of all the expenses. Cost of goods sold includes cost of merchandises. Plus, you'll see that in exam. Shipping, workman's cost, pressing, repairing, returns to vendors. Any discounts is all subtracted minus that, and that's what my cost of goods sold. This is what I actually made for every unit after I subtract all the true costs. Don't different when I say I do my own oil change instead of going to Jiffy Lube or to the dealer. Well, how much does it cost you? I buy the oil. It costs me $15. I get the best quart. Okay, very good, $15. I buy a filter, $10, $5, best filter. Okay, that's $20. What's Jiffy Lube? $26. Okay, how much is your time? What do you mean my time? How long it take me? Half an hour. How much are you worth? $10 minimum wage, $15. I think it went up to $13. $13 1 hour. What about driving there to get there? Well, I had to go there anyway. You have to take the time. Okay, how much time did it take you? You have to wait in line. Oh, it's slow business, right? This is really busy, so I wait in line. All that is time. And then when you came up, when you look at this, you had to get it rid of. What do you do with the oil? I dispose of it. Where, like my son goes, it came from the earth, goes back there. No. You got to put it in the disposable. Now you got to drive it back there if you're environmentally safe, and you put it back. You don't throw it in a garbage can to dispose of it. All that is time. It keeps me busy, yes, but now you're looking at it. Hey, is it worth it just to have Jiffy Lube do it for $25, $26, or you wait till they're out there waving and you get it? I'm thinking as a business. Okay, he's selling me this product. I don't know. I don't want it. I can't use it. What the heck? I'll give it to you. I get rid of it. I buy it because I know another supplier, another store is looking for this because I got a network with him. I'm not in the business. I buy it. I call, hey, Jack, look, I bought this stuff. I don't know what I was thinking. I had a bad day. Sally, I bought all this stuff. I want to get rid of it. I'll give you a deal. I'll give you what I paid for it. And what did they pay for it? They already added the handling charge, 20%. It's still cheaper than he could get it or that store couldn't get it. Doesn't have the relationship. And now I'm using that extra cash. I got rid of it, transferred it to them. He loves me. She loves me. I helped him out. I've got the cash, improved my cash flow. Now I buy what I want. I'm upgrading. I'm a business person. I'm using that creativity that you learned in fashion design, how to put different clothes together, how to make different colors, how to put this thing, how to change the style. It's already bell bottom, but it's a bell bottom with a curve, or it's a bell bottom with this. You got a bell bottom up here, it's got fluffy. Whatever. You utilize that same intuition, that same creativity that you already have. You just train the left side. Hey, come on over. I got an idea. Let's work this out, okay? Cost of goods sold. I have to understand the dollar amount. Even though it's a dry. Workroom costs, returns, vendors. It's supposed to be vendors. Okay? misspelling, return to vendors. That's what the RTS stands for. Okay? Cash discounts. When I use cash discounts, remember, a manufacturer or your supplier is going to give you a cash discounts because they want that money to improve their cash flow. You have to look at it. I get the cash discounts to pay, but I have to take a loan to get the cash discounts. I want to get in temp. That's something when I go in there and say, hey, you want to buy, you want to take a store. I'll use Kohl's, the last store I was in there. You're going to buy one of our charge card, we'll give you 10% off. Or Menards or anything else, 10% off, use our card. Right now, right off the thing, 10% off. Or $10. I go, wait, 10% off. And then I look at it, I sign off, I get 10% off. But my interest rate is 29% or 22%. What did I make? 16%? I could use my own card for 8%. I'm not making any money. If it was 0% or something else, 100%. You see, you have to look at it, because remember, their whole thing is to get you the discounts to get the money in. But if you got to take a loan to get the discounts, not worth it. If you're doing a discount, all you have to do is be late. One day, it's a discount. If you don't give them the money by that, when it says 30 days, 20, 30, you don't get it when it's 20 days, you don't get that discount. So if you're counting on it, you're paying full amount. So you have to understand those triggers. You put it in the system, technology. I have to pay them by this time to get the discount, and then it offsets everything else. Okay? Cash discounts, direct expenses, running the store, attributes to a unit of business or renting, payroll, advertising. That's part of direct expense. And direct advertising sometimes could be on indirect in here. Payroll, I got to pay them no matter what. They're a burden. Whether I'm selling or not, I got to have somebody open up the store. I got to have somebody there. You see some stores come in there. I look in, there's only nobody in there. I hate to go in there because they have no one. Oh, please talk to me. I like to look around, talk to me. It's like, oh, find a customer. Can I help you? Can I help you? Oh, my goodness. Or some people come in, yeah, go ahead there. Hey, you're busy. Remember, it depends on the store, on your employees, but mostly I got to pay them. Okay, so it's a direct expense for the business, right? I had the electricity and everything else. Okay, general, not one unit's advertising, indirect, and advertising falls in there. Gross margin on a return on investment, so they go GMROI. A return on investment, the difference between sales and the cost of goods sold, or the gross profits. Just another word, excuse me, for gross profit. Integrates two performance measures. Gross margin. I got the gross margin. So what I'm looking at, excuse me, if I got high stock turn, remember that inventory stock is or sell through, and high gross margin, I want that. Low stock turn, because my inventory is not selling through that day, I'm not selling enough product, is a low margin on return. I'm losing money. I got enough product. I got to sustain it. If I sell 1 or 2 units, at least it pays my bill. And if I look at this, let's look at the distribution. A lot of times you'll see a truck, a big semi truck. When they're fully loaded, yes, very effective. And then you see that big semi-truck coming back, and all it has is just an itty-bitty little tractor on there. What the heck? What's he doing? He went and got his money getting there. That's where he paid the round trip. He said, now I'm going to come back. Somebody wants to ship something that's not cost-effective for a big semi or anything else. I'll pick it up as long as they pay my gas. And, just to get back home, so I'm making money. So that offsets some of my expenses. Okay? So that's gross margin. We're doing pretty good on here. Just hang on a second. We'll be done in a second on here. Okay. For some reason, I'm going to close it up, but I'm already recording, so I don't want to close up the system. I got a lot of stuff open. Okay, and here's your formula. We had this before. Your author had it. Gross margin and return integrates two performance measures. Gross margin, blah. The formula for gross margin on investments is the gross margin dollars. You already figured that out by the net sales times the net sales by the average inventory. And that percentage will give you that number will tell you your profitability that you're looking at, gross profit. Okay? All right? So I think we've done everything else. So what do you think, class? There's a lot in accounting. Those of you who are taking accounting, I just whet your appetite. Those of you who are taking this because you have to have an accounting class. This is part of the retail merchandising where you're taking accounting budget. You have to understand the dollar amount. You're not going to move up in any organization. You're not going to move up your business if you don't understand the dollar amount. How much it's costing me? Where's the inventory? Buyer, what's the seller selling it for? What's the customers wanting? What's the income statement? I want to get a loan. I have to get my house in order. Make sure my income statement's looking good. Make sure my savings account is up. My checking account is there. My cash flow is up. That my credit score is up. Remember the credit score that you see as a consumer, businesses have a credit score also. Some people have taken me for accounting, not accounting. I don't teach accounting. I teach finance. But to be finance, you have to take all accounting majors. My heart's not really an accountant, very rigid. But I have to understand those numbers. The finance is more fun because you can play around with the money, but you have to look back at the numbers to see if it's working. Okay, so when I look at finance and accounting, what's the difference? I look at the scale real quickly. I'll give you my last a few seconds. A bathroom scale, I step on the scale, it says, George, you weigh 190 pounds. Oh my goodness, I weigh too much. Why? Because, I've got, an average person should weigh 150, 65. The scale is my accountant. Raw numbers, doesn't tell me, here it is. How do I lose that? I could play with the numbers, creative accounting, that's you go to jail, no good. I could adjust the scale a few pounds to my favor, one way or the other, no good. But I have to know, quit eating the Twinkies, use the exercising. I have to understand the body. I have to know the accounting, all these little statements. How do I change this number to improve my ratio? How do I change this number to improve my profitability number? What I do to improve my turnover? How do I do to my percentage of sales to my gross profit margin? Everything you're learning on. That's how you're talking to your banker. That's you got to say, I understand the gross profit margin. I understand this. Here's my turns. Here's my sell-through. Here's where I think I'm going to pay your loan back because of this. I'm going to retain so much earning to pay for the interest. Now you're talking. He knows you're creative. You got the natural ability for designing and making a product, and now you understand the money side to keep that business sustainable and what you need to do to make a profit. And as you make a profit, you grow. As you grow, you tax more. The government loves you. They no longer give you the tax breaks or the grant because you're a small business, you're growing. And as you're growing, your creditors love you because you're coming back for more cash because now they know you understand the management. You're creditworthy, you have collateral, you understand the business, you understand the cost, you understand if I buy the product now, this cost, how much is it going to cost me down the road. I'm going to lose money within 6 months. Looks good now, but over the 6 months and paying all these other costs, rental, insurance, transportation, and if too much of a risk or I'm a risk taker, this will make it or break it. And sometimes those are decisions you have to do. Intuition, your brain, your creativity, and taking courses like this, understanding the accounting, take a QuickBook class, to learn some Excel. You don't have to be an expert just on how to move it because all budgets are there. If you're going for that promotion within the company, you need the Excel. If you're doing with small business, hey, I'm creative. I'm a fashion a student in the fashion program, but I've taken retail merchandising. I understand QuickBooks. Oh my goodness, you got creative and all this, and you got a brain. Not that you don't have a brain. Remember, for a business person, I'm looking at you understand my business component. Remember, I need your creativity, but now you understand the dollars. How do I move this? How to move in the chain? How do I get people to buy my product? I understand. That's what they're thinking. My return, my investment. Okay? So we've learned a lot by, so remember the 3 statements you have to know is your income statement, profit or loss, your balance sheet, your what you owe and what you own, your assets and your liability, and then the last one is the cash flow, your checking account, how much cash to pay the bills. If you know those 3 statements and you know a little bit algebra, percentages and decimal, a little bit different, take I think there's a math class, Mkt106 or thing, if I'm mistaken. It's basic fundamental math that gives you the ideas, gets you ready for accounting class, gets you start thinking financial, brings you up to scuff with your adding and subtracting, and you should do well. All right? Use the technology to help you. Technology only help you so much if you don't understand what those numbers are. Read the chapter, use my mind maps, add on to that, use this for your studying. You have everything you want, and I'll see you in the next chapter, chapter 11. Again, my name is Dr. George Mochocki. This is Retail Merchandising, and today we were talking chapter 10, Introduction to Basic Accounting. So you'll still take more accounting classes, just a quick overview to understand that accounting is a language of business. It deals with money, and all of us, like it or not, money is a tool that you need to get your product in and customers buy, and everyone does well if we understand the expense sides and what the customer is willing to pay. If I know that relationship and know what my competitors are doing, I will be sustainable, I'll be profitable, my business grows, and I'll be a happy retail merchandiser. Remember, I could contract this out, but I still have to understand how it works. Again, my name is Dr. George Mochocki, and thank you for taking this class with me.